Tiny, what is the difference between company tax and personal tax?
Okay. So in Australia, there's lots of different tax laws, but generally years ago it used to be good to have a company because if something happened with the company, you weren't liable, the company would just close. All those rules have changed. So to give you a really simple understanding, personal tax at a high level is 50%. Company tax is 25%. And accountants want you to form a company. The only reason generally is so that they can charge you more. They charge you more to do a company return than a personal return. So to bring it into basics, if you earn $200,000, and let's say your personal tax rate is 50 cents on the dollar, you pay $100,000 tax. If your company that you own earns $200,000, it pays $50,000 tax. However, if you want to draw that income, that $150,000, you still have to pay another $50,000 tax because you get what's called a tax credit for the 25%. So there's no reason if you're starting out to form a company at all. You might run your business, private or a partnership, okay, for the rest of your life, and it's fine. If you are going to distribute shares and you want to start with a company and your goal is to have quite a large company and later on you're going to sell shares and you're going to give bits and pieces of your company to your staff, then you form a company. But there's absolutely no reason for 99% of the people to actually start with a company. You start as a personal sole trader, and whatever your tax rate is, it's your tax rate. If your company, and you want to, a good example is, if you're never going to take anything out of your company and you want it to grow for the next 100 years, well, great, leave it as a company. But if you want to draw on that, you're going to pay that tax. So whether you're self-employed by yourself and a sole trader, you're 50 cents on the dollar. If you're a company, you're 25 cents on the dollar, and then if you want to take the money out, you're another 25 cents on the dollar. So there's no reason to have a company, okay? Unless, as I said, you want to form, it's going to be a very huge company, you're going to have partners, you're going to have shareholders, you're going to have investors. Great, form a company. But don't spend thousands of dollars on a tax return every year just because your accountant said that you should form a company.
So if we don't form a company, how to function, how to work within the system?
You just become what's called a sole trader, which means that the government gives you an ABN, you collect GST. If you're over $75,000, you believe you're going to be over $75,000 income each year. So it's basically, and your bookwork is very simple. Your bookwork is very simple. Whatever's left at the end of the year is what's called your income. That's it. So if you run a business and it's $500,000 a year turnover, or let's say $550,000 turnover, $50,000 goes to GST, $500,000 is what's left over, $400,000 is your costs, $100,000 is what's left over, that's what you pay tax on. If it's the same scenario, exactly the same scenario for a company, well, the company has $100,000 profit. It pays $25,000 tax. And if you want to take income from the company, which is the $75,000 that's left over, you still have to pay tax on that as the owner of the company, okay? There is, I mean, I won't get into complicated tax things, but if you're 5 years before retirement and your accountant says form a company because the company tax is 25 cents on the dollar and you leave most of the money in the company, when you retire, you've got 25% tax credits. And if you retire and you just want to have an income of $60,000 a year from your company, okay, it's already been taxed at 25 cents on the dollar, and your tax rate might only be 25 cents on the dollar, so you do not pay any tax for the rest of, well, let's say you have $600,000 in the company, okay, and you draw $60,000 a year, for the next 10 years you don't have to pay tax. So that's in very rare cases. Okay, but I used to own an accounting firm for quite a few years, so I got on top of most of what's happening. The rules do change, but once again, don't form a company because your accountant will charge you 5 times more. Okay, and you don't need to unless you're going to be super huge investors, shareholders, splitting shares, all that sort of thing. Just form a business. You can change that business in 5 years to a company if you need to. So there's not, but you can't really change a company back down to a sole trader. Okay, that becomes, you can go from here to the company, but from company to a sole trader is a big difference.